Part 2, just the rules. Let's talk about shareholder voting, shareholder inspection rights, close corporations, mergers, and takeovers. Okay, so shareholders vote by proxy, and we know this, a proxy is both a document and a person. So what can shareholders vote on? What do they have to vote on? Amending the articles of incorporation, but the big deal here is usually electing new directors. So shareholders are also allowed to vote on fundamental transactions like mergers. So amending the articles of incorporation, electing new directors, and fundamental transactions. Amending the articles of incorporation, electing new, that's right, directors, and fundamental transactions. What's a fundamental transaction? A merger, a sale of the corporation. So who gets to vote? Shareholders of records. They held shares on the date, the record date. They may have sold them in the meantime, but if they hold shares on the record date, they're allowed to vote. Okay, and remember, shareholders vote by proxy. So you can cast your votes by a proxy card, or you can show up at the director at the annual meeting. Okay, let's talk about shareholder proposals. Usually shareholder proposals are suggestions for the corporation to address, examine, consider. They're usually related to environmental or social issues, not related to corporate governance, because that's a board of director area. So it's related to things that the corporation, that the shareholders feel the corporation should pursue. Okay, so this sounds kind of wishy-washy, but it's actually fairly a big deal to the SEC. The corporation has the burden to show the SEC why a proposal should not be included. So shareholders are owners. They get to make proposals, and the corporation has the burden to show the SEC why a shareholder proposal shouldn't be included. Okay, so the shareholder, if you want to make a proposal, you have to appear in person or via their agent. And each shareholder gets one proposal per year. So when can a corporation meet its burden to show the SEC why a proposal shouldn't be included? Well, if it's totally unrelated to the corporation's business, or it goes to the company's ordinary course of business. This is the big one. If something goes to the company's ordinary course of business, as in what products it sells or what services it offers, that is a director decision. So the corporation will probably meet its burden to show the SEC why that proposal should not be included. So, number one goes to the company's ordinary course of business. It could also be something the company just doesn't have the authority to implement, something that's illegal or improper. It's totally unrelated to the corporation's business, or it's just a personal grievance. Hey, we don't like it that you sell bombs for Vietnam. Well, too bad. That's a director decision. Okay, so who has the burden to show the SEC why a proposal should not be included? That's right, the corporation. What's our main test here? Goes to the company's ordinary course of business. And then personal grievances, that's not gonna work. The corporation just lacks the authority to implement it. But the main thing is that it goes to the company's ordinary course of business, like what products they sell. Okay, so if the SEC says, okay, you have the right not to include that proposal, the SEC will issue what's called a no action letter. And essentially this means SEC is not going to recommend an enforcement action against the corporation. No action letter. The SEC will not recommend an enforcement action. Okay, so moving on. So really quick summary, proxy rules. Shareholders vote by proxy. What can they do? They can vote on amending the articles of incorporation, electing new directors, fundamental transactions like mergers. Who's entitled to vote? Shareholders of record. They held the shares on the record date. Shareholder proposals are merely, that's right, suggestions. Who has the burden to show why a proposal shouldn't come up at the annual meeting? The corporation. And what's our main test here? It goes to the company's ordinary course of business. And also it just might be something the corporation lacks authority to implement. It might be a personal grievance, might violate the law. The SEC has the authority to exclude a proposal by not recommending an enforcement action, and this is known as a no action letter. That's right. Okay, moving on. Shareholders, as we mentioned before, have inspection rights. Inspection rights. Shareholders can inspect books and records. The burden is on the shareholder to show a proper purpose. Proper purpose here is easy. You want to inspect the books and records? It's for any proper purpose. But what about stockholder lists? So books and records, now remember, if this is a public corporation, they have to disclose all of that stuff anyway. But if it's a private corporation, the stockholder just has to show that they have a proper purpose for inspecting the books and records. And that's any proper purpose. But what about stockholder lists? This is tricky. Why the heck would a shareholder want the stockholder lists? Perhaps for a proper purpose, perhaps for an improper purpose. So a stockholder list may be requested for any proper purpose reasonably related to that person's interest as a stockholder. In other words, their economic interest. So a shareholder can request a list of all the stockholders for any proper purpose related to that person's interest as a shareholder, their economic interest. Why is this different? Okay, so people will buy shares just to get access to the stockholder list for an improper purpose. So that is why the standard is higher. The burden's on the corporation to show that improper purpose, but a proper purpose is reasonably related to that person's interest as a shareholder. Okay, quick. Shareholder inspection rights. Any shareholder has the right to inspect the books and records for any proper purpose. For stockholder lists, for any proper purpose related to what? The person's interest as a stockholder. Okay, so the burden here is on the stockholder to show proper purpose, but for a list, the burden's on the corporation to show an improper purpose. Okay, so let's talk about shareholder agreements. Shareholder agreements. Shareholder agreements are enforceable at law, and they're just a essentially buy-sell agreement that it's an agreement on how to vote shares for vacant director positions. Okay, so let's talk about how this is handled. A corporation can use straight voting, one share, one vote, or if we have a close corporation, the shareholders might get cumulative voting rights. So, what can shareholders vote on? Oh, yes, directors, appointment of directors. So, cumulative voting rights. We're going to multiply the number of shares that person owns by the number of vacant director positions. Okay, so let's give an example. So Mr. T owns 100 shares of the corporation. We have 3 vacant director positions. Mr. T gets 300 votes. There are 3 vacant director positions. He owns 100 shares. 3 director positions are vacant. He can cast 300 votes. That's cumulative voting rights. Cumulative voting is the default. Some states will use straight voting as a default. That's usually in the Articles of Incorporation, and it's governed by the states. Okay, what are cumulative voting rights? Multiply the number of vacant director positions by the number of shares that stockholder owns. Okay, we talked about shareholder agreements. These are agreements on how to vote shares for vacant director positions. This is just a contract. It's an agreement between shareholders to vote a certain way. Okay, so moving on from shareholder agreements to mergers. Okay, so we have a statutory merger and a de facto merger. All right, so a statutory merger means that 2 corporations join together, but only one of them continues to exist as a legal entity. In other words, it is acquired by the target corporation is acquired by the acquiring corporation. So only the acquiring corporation continues to exist as a legal entity. Who do you think this requires approval from? Well, yeah, the board of directors, but how about the shareholders? Both companies need to approve a merger. Remember, shareholders get to vote on transactions that are material to the corporation. They can vote on amending articles of incorporation, electing new directors, and fundamental transactions. Fundamental transactions include merger. So our statutory merger is what? 2 corporations join, but only one of them continues to exist as a legal entity. What about a de facto merger? All right, so how does this happen? The transaction is structured as an acquisition, and the owners of the target corporation become owners of the acquiring corporation. The target corporation is immediately dissolved. And how does this happen? Purchasing of their shares through a tender offer. Tender all your shares, and we're going to merge. And purchase of all the business assets. So purchase of shares through a tender offer. What's the risk here? The risk is that the corporation is going to ask the target corporation to sell their shares at a discount. So, what does this trigger? Appraisal rights. Shareholders have a right to fair market value of their shares. So, any dissenting shareholder has appraisal rights. Why? Because of the duty of loyalty and entire fairness to shareholders, because we want the shareholders to receive fair market value. Okay, so if the corporation is going to acquire the corporation by purchase of shares, the stockholders need fair market value, and this can trigger appraisal rights based on the duty of loyalty and entire fairness to the shareholders. Remember, there's a fiduciary duty to all the shareholders. Minority or dissenting shareholders have those rights, as well as shareholders who are totally in favor of the merger. If you dissent, you're entitled to appraisal rights. Okay, what about a merger or a takeover? Well, a merger actually, where we're talking just about purchase of all the target corporation's business assets. Do you think the corporation has a fiduciary duty to the target corporation? Yes, of course, they have those fiduciary duties, duty of loyalty, duty of care. But if you're just going to purchase the business assets and not the stock, do you think that triggers appraisal rights? No. But the corporation has to list the fair market value of all the business assets, equipment, and inventory. Okay, so real quick, purchase of shares triggers what kind of rights? Appraisal rights for what? The fair market value of shares. Why? Because there's a duty of loyalty to the shareholders, which requires, that's right, entire fairness. Shareholders are entitled to receive fair market value. What about if they just purchase the business assets of the target corporation? Does that trigger shareholder appraisal rights? No. You're just buying the property. Does the corporation have a fiduciary duty? Yes. What's the fiduciary duty? To list the fair market value of everything they're purchasing. List of all the business assets, equipment, and inventory and their fair market value. So the purchase of shares, appraisal rights. Purchase of business assets, no appraisal rights. In both cases, we've got fiduciary duties. 1, fair market value of the shares. 2, fair market value of the inventory and equipment. Okay, mergers require approval of the board of directors, but who else? The shareholders of both companies. Okay, so we've got our statutory merger and we've got our de facto merger. In substance, these are not that different. The owners of the target corporation become owners of the acquiring corporation, and the target corporation is dissolved. Okay, let's talk about takeovers. Do we need fiduciary duties? Yes, the duty of care and the duty of loyalty. The standard is, of course, the business judgment rule. It's entirely fair to the corporation. The business judgment rule presumption presumes the directors are acting in good faith and with the best interests of the corporation in mind. So takeovers are generally good for the shareholders because the stock is bought at a premium by the takeover company. Who needs to approve a takeover? The board. The board. A takeover of the corporation requires the board to approve mergers and takeovers pursuant to their fiduciary duties. But takeovers trigger the business judgment rule. What does the business judgment rule state? Presumption must be entirely fair to the corporation, and it's a rebuttable presumption. The shareholder has to show what? Bad faith. Okay, what's bad faith? That's right, being interested in the transaction, influenced by a person who is interested. So if a director is interested, they're under the influence of someone who wants that transaction to go a certain way. And they can also be interested if they appear in both sides of a transaction or engage in self-dealing. That's always bad. So remember, in any takeover, the shareholders are entitled to a fair market value for their shares if they choose not to participate in the takeover. And the directors have to be disinterested, not be on both sides of the transaction, or engage in self-dealing. Okay, so hostile takeovers. All right, hostile takeovers, meaning that the target corporation is not at all interested in having that takeover happen. So, what is one defense to a hostile takeover? Oh, yes, the poison pill. Okay, a poison pill gives the shareholders the right to buy more shares at a deep discount if one shareholder buys a certain percentage or more of the company's shares. So if we have a shareholder trying to make a hostile takeover, the corporation can issue a poison pill, allowing the shareholders to buy more shares of the target corporation to defeat that hostile takeover, defeat that person's purchasing of all the shares to become the controlling majority shareholder. Okay, what if if it's just inevitable? Inevitable. When the sale of the company appears to be inevitable, the fiduciary duty of the obligation changes from protecting the corporation to just maximizing stockholder value. In other words, getting the best price for the shareholders. Okay, so this is best illustrated by Paramount versus Time. Okay, Paramount sued to force a merger with Time, stating that the company was up for sale just because they were shopping for buyers. But the court determined that the company wasn't simply putting itself up for sale because they were shopping for other buyers. Their actions were reasonable in relation to the threat. Okay, so now we're going to talk about offerings of securities. So we have our public offerings and we have our private offerings. So public offerings or IPOs, very big in the 80s and 90s. What do we need from the corporation that is trying to go public? Full disclosure and continuing disclosure of all material facts. What do we need for this? Quarterly audited annual report, and the corporation has a duty of continuing disclosure. So if you're going for an IPO, you're going to file a registration statement with the SEC, and then you have to do full disclosure of all material facts and continuing disclosure using quarterly and audited quarterly annual reports. Okay, so what about if we're in a close corporation? A close corporation might be exempted from the registration requirement. So if you only have 8 shareholders that are offered an interest, so that might be a private offering. Private offerings are exempt from the registration requirement. And this is Regulation D. So the result of this is that most companies' offerings are now private offerings. Who wants to go through all of that? Registering with the SEC, full disclosure of all material facts, continuing disclosure, and then the requirement to continue offering quarterly and annual reports. That's a real pain. So one can create a private offering. So this is subject to SEC Regulation D. So there are 2 exemptions for a private offering. If you're a close corporation, you don't want to go through the whole IPO process to sell your shares on the secondary market. So we've got a small offering exemption. If we've got 7.5 million at stake, that's our limit, or 35 purchasers plus unlimited accredited investors. Okay, so why are most offerings now private? Nobody wants to go through all that. What are our 2 requirements? The small offering exemption and 35 purchasers plus unlimited accredited investors. Okay, what the heck are accredited investors? Accredited investors are big institutional buyers, or they're individuals with an income of $200,000 or $250,000 for a married couple, or $1 million in assets, or they pass the Series 7. Okay, so how do we get a private offering? You're going to file a private placement memorandum with the SEC. It's not public knowledge, it's private. Okay, quick, let's go through private offerings and public offerings. What do we need for a public offering? We're going to file it with the SEC. The SEC has to approve it. We have to full disclosure of all what kind of facts? Material facts, and continuing disclosure after the company goes public with quarterly and audited annual reports. Okay, so the most frequent offense here is sale of securities that should have been registered. Okay, but what about our private offerings? Why are those attractive? That's right, they're exempt from the registration requirement, and a private offering hinges on investor status. What do we need to file with the SEC? A private placement memorandum. Who gets to purchase pursuant to a private offering? Okay, well, it has to be a small offering, 7.5 million or less, and the purchasers, we get 35 purchasers and unlimited accredited investors. 35 purchasers and unlimited accredited investors. This is how Edward Jones offered private offerings. The accredited investor has to be a large institutional buyer or an individual or married couple, 200,000, 250K, or $1 million in assets, or they pass the Series 7. Interesting. Okay. So we're going to cover securities class actions. And we've already covered insider trading on the basis of material non-public information in violation of a duty of trust and confidence owed to the company or its shareholders under SEC Rule what? 10b-5. We covered tipper and tipper liability. And then we go into LLCs. Okay, so let's just go really quickly through the securities, through the insider trading. So our insider trading rule is trading on the basis of, that's right, material, non-public information in violation of what? A duty of trust and confidence owed to the company or its shareholders. And what rule is this? That's right, 10b-5. All right, so what does 10b-5 prohibit? Trading on the basis of material, non-public information in violation of a duty of trust and confidence owed to the company or its shareholders. Okay, so who's an insider? Any employee of the company. And they misappropriate that material, non-public information because they have a financial relationship related to the source of that information. If you're an employee, do you have a financial relationship with the company? Yes. So you've misappropriated. You failed in your duty to disclose material. You failed in your disclosure of material, non-public information in violation of a duty of trust and confidence owed to the company or its shareholders under SEC Rule what? 10b-5. How does this generally happen? Well, somebody tips somebody off. So the tipper is somebody who's an insider. They're going to breach that fiduciary duty of trust and confidence. And they're liable if somebody actually traded on the information. They obtained a personal benefit. They knew, or they should have known, that that information was confidential. They breached their fiduciary duty of trust and confidence. Now, what about tippee liability? So the tippee is someone who knew or should have known that we were trading on the basis of material, non-public information in violation of a duty of trust and confidence owed to the company or its shareholders. That's insider trading, that's securities fraud. So the tipper, that person with the material, non-public information, gives that information to a tippee, and the tippee can be personally liable for that. Okay, so if you trade in your own company's securities, are you automatically liable under tipper liability? No. We have the disclose or abstain rule. If you disclose all that you're going to trade in your own company's securities, you have to disclose that information for the public. Or just abstain from doing that, abstain from trading your company's securities. Disclose or abstain rule. What do you have to do? Disclose all the information about your trade to the public. Or do what? Abstain from trading. Okay, we've covered a lot of ground here. Let's go through practices. We went through derivative actions. Proxy rules, shareholders vote by proxy. A proxy is a document or a person. Shareholders of records are who? People who own their shares on the record date. Shareholder proposals are merely, that's right, suggestions. They can't go to the corporation's, that's right, ordinary course of business or just be illegal, improper something the company doesn't have authority to implement. But the corporation has to show what? They have the burden to show the SEC why the proposal should not be included. And what does the SEC issue in response? That's right, a no action letter. All right, what about shareholder inspection rights? Books and records? To the stockholder? Burden? Any proper purpose. Ooh, stockholder lists. That might be a little more dicey. Burden is on the corporation to show any proper purpose related to that person's interest as a shareholder or their economic interest. Why? Because we don't want people misappropriating the stockholder lists for their own purpose. Okay, what are cumulative voting rights? What's our formula? Number of vacant director positions times the number of shares you own. What's the default? Cumulative voting as is the default. Straight voting, one share, one vote, is a creature of state law. So either way, it's a creature of state law. Cumulative voting or straight voting. That's based on state law. What's a shareholder agreement? It's just a written contract that individuals decide between themselves on how to vote shares. Okay, so we didn't talk about freeze out. We'll talk about that later. What about mergers? Who does it require approval of? Well, the board, of course, but who else? That's right, the shareholders of both companies. And there's a difference between a statutory merger and a de facto merger. Okay, statutory merger, two corporations join together, but only one of them continues to exist. A de facto merger is an asset acquisition merger. Who becomes the owner of the acquiring corporation? The owners of the target corporation become owners of the acquiring corporation. Okay, so we can execute a merger in two ways, buying shares or buying business assets. Okay, so the purchase of shares, the acquiring company tenders an offer to the other company. And what does that trigger? That's right, appraisal rights for the fair market value of the shares. Why? Because we want all shareholders, including dissenting shareholders, to get fair market value. The duty of loyalty requires entire fairness to all the shareholders, the acquiring corporation and the target corporation. You cannot just go in and say, we're going to buy your shares at way less than fair market value. That's not allowed. Okay, what about if you acquire something through purchase of business assets? Does that trigger appraisal rights? No, we're not selling stock. You just have to list all the assets, equipment, and inventory and their fair market value. Do fiduciary duties of care and loyalty apply? You bet they do. Okay. Takeovers trigger entire fairness. Remember, we have our interested director transaction rules. Do we want the directors on both sides of the transaction or engaged in impermissible self-dealing? No, we don't want any detriment to the shareholders of the target corporation. So a director can be interested if they engage in self-dealing or what? Are on both sides of the transaction. Okay, what about a hostile takeover? The target company doesn't want to be acquired. What can they do? Well, one defense is a poison pill. So we're going to give the shareholders the opportunity to do what? That's right, purchase extra shares at a deep discount. And it's triggered by what? The purchase of a large number of shares, a certain percentage, by a target person or a target corporation. Okay, does that target acquiring person get rights to the poison pill? No, they don't. That's our defense. Our defense is the poison pill. Okay, but what about if the sale of the company is just inevitable? The corporation has been shopping it around. The corporation has been trying to be acquired. It's inevitable. The corporation is going to be taken over anyway. So if that's true, when the sale of the company is inevitable, does the board still have a fiduciary obligation? Yes. But what does that extend to? When the sale of the company is inevitable, the function of the board changes to maximizing shareholder value. Okay, quick. Public offerings. What do we have to disclose? All material facts and continuing, that's right, disclosure after the company goes public. Nobody wants to go through all this. So most offerings are now, that's right, private offerings. Do they have to register with the SEC for a private offering? No. No. So we have our small offering exemption. What's our limit here? $7.5 million. That's a small offering. What do we have to file with the SEC? A private placement memorandum. Private, it's not public. Easier. What do we get with our private placement offering? 35 purchasers and unlimited accredited investors. Who's an accredited investor? Two prongs. That's right, a large institutional buyer or an individual with an income of 200,000, married couple 250, or how much in assets? $1 million, or they pass the Series 7. Okay, so insider liability, trading on the basis of material non-public information in violation of a duty of trust and confidence owed to the company or its shareholders. Okay, so we've got our tipper-tippee liability. They're both liable. The disclosure abstain rule, our last topic. Can you trade in your own company's securities? Yes. Yes. If you disclose to the public or you just abstain. If you're going to disclose in your company's securities, you have to disclose that to the public. Okay, and this, of course, only pertains to insiders. If you're an outsider, you can do whatever you want. All right, and that is part 2 of corporations.